what I quickly realized was that people were basically investing in us, and the business was growing based on our personality. So not based on any assets in the business. So I was almost like a singer. I had to keep singing at the band, every week to keep the business going, the revenue coming in. The top 1% of production in wine, whiskey is just like top 1% of real estate. It moves into like the luxury economy, the luxury
Hmm.
market. And that's where we want to be because, you're extra non-correlated to the market at that point. These assets are non-correlated to the market anyway. What happened last year in 2020? The Bernard Arnault, who's the godfather of luxury and CEO of LVMH, leapfrogged Bezos and Musk to become the world's richest person in a contracting economy where the S&P is down, whatever it was, 19% or whatever. That is where we want to be. So we want to just take the cherry of the cherry of the cherry on top of all those benefits and give that to our investors.
Wow. So what are the products do themselves? They just sit on a shelf, or where how does it work exactly? Like where do these get distributed out? Who's buying them? Where you guys are able to profit from that?
Yeah, so think of it like this, right? They get produced from the vineyard or the produce or the distillery, which is effectively like agriculture. So it's effectively like a farm. And then it gets bottled, and then that bottle has like a wholesale value. So what we're not doing is we're not buying bottles and barrels at the top price and hoping that they go up. We're not doing that. Just like in real estate, you don't want to be doing that. What we do is think of like, imagine you've got like $100 bottle of wine or whiskey in front of you, and it's 10 years old. So it's taken 10 years to get to that point, that point of value. So we don't buy it at that point, hope that it goes up even more. What we do is we look at it as 10-year age, and we look to buy it basically 3, 4, 5 years younger at ideally 30 cents on the dollar. You know what I mean? So it's like when you go into real estate, you look at buying the land cheap and then adding the value
Mhm.
later. So the cool thing about this is that the value add that we do is just throwing it in a warehouse and just making sure the temperature is right, and the humidity and the lighting and that sort of thing. So we make sure that it's aged perfectly, and not just that, but it's got what we call provenance, which is basically authenticated documentation that we can prove that it's been aged in the best conditions, so that whenever we go to then sell it to Michelin star restaurants or the Marriott Hotel or whatever, we can prove to them that it's at the best condition, the highest quality, the label's immaculate, so that their clients paying $10,000 a bottle of when it gets to their hotel room, enjoys a fantastic piece of wine or whiskey.
This is so cool. I'm involved in like basically I've hacked cars, like exotic cars before, and
Cool.
it's very
I don't think you should say
similar.
that. I don't think you should say that online.
No, I shouldn't say that online, the idea is essentially you figure out where the car is going, like as far as price, because those depreciate obviously fairly quickly, and you kind of find where they bottom out, and then you buy the car and you get like a mile allotment as to how many miles you can drive with it before it starts to lose its value based on kind of historicals around that type. Now, obviously, there's specs involved. There's the color, all that stuff. It all matters. The mileage, but similar in a sense that you guys are increasing value with your kind of in the luxury market, predicting out by looking at, hey, this one that's aged at this level is worth X. If we just buy it here and sit on it, it's going to be worth more later,
Yeah.
which is pretty cool.
Yeah, so you've almost got like predictable value creation in
Yeah.
two components. The first component is you can't cheat time.
Right.
And if this is selling, if a 10-year-old selling this much today, if we just buy the vintage or the vintage, that's the only word for it, the vintage, 3, 4, 5 years earlier of the same production, and it was a similar year that year, you can almost see into the future, right? Because you can't cheat time, and there's intrinsic value creation in the maturity of the asset, which is just it's sitting in a warehouse.
Yeah. So when you're purchasing at the 30 cents on the dollar, so you're buying obviously the newer stuff, are they selling to you at a discount on top of it, or is it just that's what it is at retail and it's going to go up from there?
Yeah, so we not yes, a 5-year-old of the same product, same production, will eventually get to the 10-year-old's value in terms of all that sort of stuff. But we want more. We want more alpha than that. We want to generate more alpha, more vig. We want more of an edge than just that. So what we also look at is we look at, betting big when inflation is high, because these assets usually do well in a high inflation environment because they're on the sell side of inflation, not on the buy side, right? So you want to be riding the inflation wave, not getting wiped out by it. And also what we do is, obviously, we come in with economies of scale acquiring these assets. We want to make sure that every time we acquire a bunch of assets, we take a significant stake so we can almost influence, in many cases, price, volume, and depth. We have 55 exclusive agency agreements where we are the more or less the monopolistic controller of that stock going into the London UK market, which is the biggest stage in the world for wine and whiskey. Every producer wants to be there. So that's like being a real estate developer and controlling all the land in a certain suburb. So then you get to really, really juice as much appreciation as you can, because you can release the stock slowly, control supply, demand, all that sort of stuff. And a big part of that, what allows you to do that, is to basically come in and buy it when no one wants it. So we buy it not just young, but we buy it when no one wants it. So we get a bit more of a squeeze there, right? Maybe 5-10%.
Mhm.
And then we look at its peak time to be drunk, whether it's 10 years or 12 years, 15 years or whatever, and then we hold it. And we hold it even longer. So we hold it when supply drops off a cliff and the market thinks there's no more left, and then we're like, boom. Then we re-release it back into the market and sell it back into the market at a premium when demand is high, supply is scarce, and there's even more market power at that point, because what happens is it takes 10 years to open one of these things, 10 seconds to open one and drink them. So, all we need to do, not all we need to do, I shouldn't say that's not that easy, but what we keep an eye on is just consumption habits. If you want the price of a real estate house or a bottle of wine to double, either demand for it's got to double, twice as many people that want to buy it needs to increase, or supply needs to halve. So the cool thing about these assets is that they're consumable. So supply is designed to diminish. So as long as we keep an eye on those supply consumption habits, then we've got a pretty good finger on the pulse of value creation and appreciation and price.
Do you also know like all the inventory that exists for the most part for that, or that's probably too difficult to track?
Yeah, so that's a double-edged sword, because there's an opportunity and a difficulty in that. The difficulty is that you can't really ever know. The opportunity is that you could almost bet that when you go back to market, like let's say the price is at $100 and there was only about 10,000, 20,000, let's say 20,000 bottles of this made, in and amongst 100 million drinkers, right? So if you go back into the market with 100 bottles, you could pretty much bet that there's going to be less than what you think there is in the market, and 100 is enough to sort of move the needle. So if you increase the price of all of those 100 all at the same time and bring them back in, the market will more or less think that it's the price.
Mm.
And and then whenever anyone is traded and one comes off the market, then you could almost itch the price up a little bit more and things like that. So it's a very, very inefficient, opaque market that has a lot of inefficiencies that if you have the right infrastructure, you can leverage.
Yeah, with real estate, I mean, all we're really doing on the multifamily side of things is we're finding inefficiencies. So anything that there's somebody that's operating their property poorly, that's always going to exist, and you can go and buy it at a discount because operations are difficult and not everybody can do them. So you're similarly you're just looking for that, and if no matter where the market's at, you can find some version of that, of course. So that's pretty interesting that you said that as well. I mean, this is really cool. So what kind of people invest into this, and what are like your normal returns?
Yeah, really good question. So we do get a lot of passion investors, people that love wine, like sommeliers, people that work in hospitality, and they've seen these bottles just be open night after night after night, weekend after weekend. So they're like, wow, of course, there's a predictable convergence to an increased value due to the scarcity, right? And we have a huge, like, remember, this is a pure investment class, it's alternative investment. It's non-correlated to the market, returns. It's not hard to get double-digit returns. You don't always get that, but it's definitely not hard to do that if you know what you're doing. And so we do have a lot of sophisticated investors, like a lot. So when you go into the office and you speak to a lot of the guys there, and a lot of guys in the industry, and a lot of guys that have been around the industry, they're ex-bankers. The ex-bankers, ex-finance guys, ex-investment bankers, ex-traders, because they're like, wow, we've seen a lot, like especially a lot of the ex-trader guys, they've invested in corn, cannabis, gold, because they've seen stocks go up and down and all that sort of thing. And they're like, okay, I've got that part of my portfolio. Now here's my long-term, I hopefully double-digit safe term deposit, safety deposit part of my portfolio that sits outside the market in its own little lane, right? So our returns for the last 4 years, these aren't returns for our fund. I'll just want to say that because our fund is brand new, but we're putting the exact same strategy into our fund. Our returns for the last 4 years have been 11%, 12%, 15%, 15% across just under 3,000 clients, 3,000 current active clients. So, across a huge portfolio of time, and also a huge portfolio of individual portfolios.
How long are people typically expected to have their funds into something like this to see the returns?
Yeah, so if you want to be in this game, you got to be, like a 5-year thinking person, 5 years plus, the more time, the better. So our investment fund is a 5-year lockup with everything out at the end. And that's the absolute shortest we can get it down, Those assets will start selling them down in years 4 to 5. And that takes an enormous, I can't tell you, we're talking about like $100,000, right? So we're talking about an enormous infrastructure machine to be able to move these assets. But it's worth it, because like I said, double-digit return non-correlated to the market.